Imagine the 18th century. Money is everywhere. Trade is active, but there are no banks. So the real question is, people did not borrow from institutions. Banks are a product of European legal tradition. They require formal institutions, state regulation, written commercial law, and abstract legal responsibility. In the Islamic world of the 18th century, financial life worked very differently. Economic relations were regulated not by ministries or central banks, but by fiqh, Islamic law. Fiqh was not just a legal system. It was a moral framework for everyday life. Trust mattered more than paperwork. Community mattered more than formal systems. Moral responsibility mattered more than legal enforcement. Financial relationships were built around contracts, not organizations. If two people made an agreement in front of witnesses, that agreement became not just a legal duty, but a religious obligation. Breaking a contract was not only illegal, it was a sin. To understand Islamic finance, we must understand one word: riba. Riba means prohibited gain, making profit from money itself, without real work, risk, or productive activity. Islam does not prohibit profit. It prohibits guaranteed profit without risk. Trade is allowed. Investment is allowed. Partnership is allowed. What is forbidden is profit that is automatic, risk-free, and detached from real economic activity. This is not only theology, it is social philosophy. Interest creates endless debt. Debt creates dependency. Dependency destroys social balance. Every financial relationship was built around one thing: act. Act means contract, not in a modern bureaucratic sense, but in a moral, legal, and religious sense. Act was not just paperwork. It was a moral commitment before God. Breaking a contract meant losing reputation and damaging your religious standing. So how do you lend money without interest? You transform the loan into investment. One of the most important mechanisms was qirad, also called mudaraba. One person provides capital, the other provides labor and management. Profit is shared. Loss is carried by the investor. Formally, this is not a loan, but functionally, it works exactly like one. Credit disguised as partnership. Now comes the most fascinating part: Mahatra contract, a legal trick to simulate interest without calling it interest. On paper, everything is legal. Two trade operations, no interest, no riba. In reality, it is a loan with profit. Islamic scholars debated this endlessly, but it was widely used. Because economies need liquidity, and people need capital. So who actually gave loans? Merchants. They were the banks. They had capital. They understood risk. They financed projects. A wealthy merchant could fund caravans, support artisans, and finance landowners. But they did not rely on algorithms. They relied on reputation. There were no credit scores. There was something stronger: your name, your family, your history. If you failed once, no one lent to you again. Economic death. No financing. No partnerships. No future. Debt was often collective. A man borrowed, his family guaranteed. Debt was not personal. It was social. Documents existed, but they never mentioned interest. Only price, goods, and time. The most common mechanism was simple trade credit. Goods today, payment later. Credit price higher than cash price. Waqf was a religious foundation, but it was also a financial institution. Cash waqf acted like microfinance. For many poor but honest people, it was the only source of capital. Of course, abuse existed. Corruption, fake waqfs, elite control. But the system worked for centuries. Were people imprisoned for debt? Generally, no. Debt was misfortune, not crime. But if fraud was proven, assets were confiscated, trade banned, reputation destroyed. The worst punishment was not court. It was social death. Sometimes debt created dependency, not slavery, but loss of autonomy. Why did this system work? Because society was small. Everyone knew everyone. You were not punished by institutions. You were punished by people. Finance was human, slow, personal, moral. Today, finance is institutional, fast, anonymous, mechanical. This system disappeared not because it was bad, but because the world changed. Personal trust could not scale. Institutions replaced people. In 18th century Uzbekistan, there were no banks. But there was faith, contracts, reputation, and responsibility. People borrowed not from systems. They borrowed from other human beings. One system created trust. The other creates efficiency. And sometimes, that made their financial world more honest than ours.